Thank you for your interest in tax-deferred exchanges. The area of vacation properties, vacation homes, second homes, all those types of topics bring up a whole plethora of issues in our tax-deferred exchange practice. We'll hit on this particular video the concept of vacation homes from a couple different aspects. One of the first misunderstandings out there today is who can we rent to, how much personal use of the property can we have, and what does it take to convert our investment property into a vacation property. So stay with me for a few minutes while we go through the process. The first way that we're going to analyze vacation properties is if you're a potential client or a client of ours that has a vacation property today, which means that it's a property that you're using for your personal use as a second home or a vacation home, and you're coming to us because you'd like to complete a tax-deferred exchange. Well, I have to tell you that you don't qualify. And you don't qualify because a tax-deferred exchange is the relinquishment of an investment property and the acquisition of another investment property. So the question then comes up, and many clients are able to take advantage of this. What can I do to make my vacation home become an investment property? A Supreme Court judge by the name of Learned Hand many years ago made a statement that's been now repeated on the internet millions of times. There's nothing inappropriate or illegal in structuring your affairs in a fashion to eliminate or preclude the payment of tax to our government. That's an actual quote from Learned Hand. And it's still true today because you can structure your investments in order to minimize the tax. And let's imagine, of course, that you have that vacation home. Let's imagine that it's a vacation home that you've talked to your accountant, and if you were to sell the vacation home, you'd have all kinds of capital gains tax to pay. Why? There is no vacation home exception to the capital gains tax rule. There is a primary residence exception, which shows up in one of our other videos that says if you live in the property 2 of the last 5 years. So one of the strategies, of course, is that you could move into your vacation home and you wouldn't have to do a tax-deferred exchange. But let's pretend that you'd like to complete the sale of your vacation home, but you don't want to pay the capital gains tax. You can do so by changing the use of your vacation home, and instead of having it as a vacation home, a weekend home, a second home, convert it into a rental. And the rental may be a full-time rental depending upon the type of property. It may be the type of rental for Airbnb, overnight type of rental, or weekend rentals depending upon the type of property. It would preclude your personal use of the property. It would allow you to rent out the property even to relatives. You could rent out the property to a relative, but you're going to have to be renting the property at its appropriate fair market value. So you can't have your kids living in there for free. It's not going to qualify unless they're paying proportionate fair market value. Which, by the way, when you think about it, just a little tangential strategy here, there is a gift tax exclusion of up to $15,000 per person per year. So you could actually rent to your kids for nothing and actually have them pay you. You give the money back to them as a gift, and you could gift up to $15,000 per person per year. So in essence, you could qualify using 2 sets of tax rules in order to preclude the ability of having to have them pay you rent for the property. Just a tangential strategy there. If you complete that transaction for a period of time, you will have qualified. My suggestion, of course, is that you don't do that 2 weeks before you sell the property. We have a phrase that will show up in some of our other videos. I use it constantly in my practice. Time solves all wounds in tax-deferred exchange. And what I mean by that is if we complete a tax-deferred exchange and we have lots of time afterwards, it's going to be more acceptable to the overall Internal Revenue Service and the congressional rules. So in the same fashion, if we rent out the property, the longer the better. We highly suggest that you rent out the property for a year. The longer the better, but at least a year. And then at that point in time, you can sell the property, complete a tax-deferred exchange in the normal fashion. And of course, afterwards, after you accomplish that, you could convert that property again. And interestingly enough, the Internal Revenue Service has a safe harbor for us. So if you were to convert that vacation home into a rental for a 2-year time period, and then acquire the replacement property and rent it out for a 2-year time period, at that point in time, you could convert its use to a primary residence. You could convert its use to a second home or a vacation home and not have any particular difficulties whatsoever. The transaction, the tax-deferred exchange, will still qualify. For many people, structuring the transaction in this fashion will be too time-consuming or may not meet your particular needs. But in reality, many clients are coming to us today looking for strategies, legal strategies of course, that will allow them to not have to complete another tax-deferred exchange during their life. They may be getting older. In many cases, they want to convert their rental property into a primary residence, or they want to convert their vacation home into a primary residence, or they want to have some variation on this particular theme. So let's go through that for just a moment. Let's assume that we have a vacation home and we have a client that would have a large tax bill to pay if they sold their vacation home. In reality, they would like to have another property that will ultimately be their retirement home. And so they rent out their vacation home for the time prescribed, as we talked about in our video today. They do a tax-deferred exchange. They acquire the replacement property in the time prescribed. They rent it out, and ultimately they move into that property. You would be surprised how many clients are able to structure their affairs in that fashion. Let me talk about one particular client. This particular fellow was a principal of a local high school in the state of Washington. He came to us because he happened to have a vacation home that they had for just about ever. It was on a lake that had highly appreciated, and they wanted to sell that particular property and buy another vacation home. Unfortunately, there is no tax law out there that allows a vacation home to preclude the payment of taxes, and his vacation home would have produced an almost $200,000 tax cost to him. He was going to buy another property, but didn't feel that he could do so with after-tax dollars. So what he did, of course, listening to our strategy, he converted the vacation home into a rental. He did so for a 2-year time period, and at the end of 2 years, we listed the property for sale. They completed a tax-deferred exchange, acquiring another property, which is a vacation property, intending ultimately to have that as a vacation property. For the next 2 years, they rented out that property, and interestingly enough, during this time period, they also decided to retire. So after about 2.5 years, they listed that property they didn't list the property for sale, they took that property in that other state that they had acquired, and they merely changed the use of that property from investment property, and they moved in because they were able to not only use that new property as a vacation property, they opted to move into that new property as their primary residence. That was not a taxable event. It allowed them to take advantage of a special rule called 2 out of the last 5, which when applied to tax-deferred exchanges is 5 out of the last 5. And by continuing to live in the property, they precluded their need to convert that property from investment property to a primary residence. They converted any tax costs that they would have to pay into an exemption, and they no longer had to complete any tax-deferred exchanges in the future. Proper planning on a long-term basis allows many clients to convert investment property into vacation homes, second homes, or even primary residences. The key thing is planning. The key thing is to talk with trusted advisors such as your attorney, ourselves, as qualified intermediaries, or your CPA in order to plan these in advance. We'd be more than happy to talk to you regarding your conversion of a vacation home or a second home into either another vacation home through the exchange process or a primary residence ultimately. Thank you for your interest today.